Welcome to our regular 6-minute strategy from me, Guy Munson. After 2 years of painful inflation across the US and Europe, the price data this quarter has been better than expected. The key to this has been declines in food and energy prices, alongside cheaper Chinese imports and markedly lower supply chain costs. In some areas we're actually seeing deflation once again, with prices falling year on year for durable goods including appliances, furniture and used cars. Better inflation data has meant lower interest rate forecasts, with US and UK markets now expecting their first rate cuts from central banks around mid-2024. Yes, central bankers continue to warn that investors are getting ahead of themselves and that the last mile will be tough, but our forecasts suggest 4 US rate cuts in 2024 as inflation ends the year at about 2 to 2.5%. For investors, a peak in interest rates is typically good for asset markets, and certainly the month of November saw a rally across almost everything. Global and emerging market equities, corporate and government bonds, even junk, gold, Bitcoin, infrastructure, and yes, even UK house prices all rose last month. In the slides ahead, we'll look at these returns in more detail and discuss whether the rally in everything suggests a renaissance for the modern balanced asset manager. So let's look at this rally in everything in a little bit more detail. I plotted returns for the fourth quarter in the left-hand panel. Gold up 9%, a key component of our alternatives portfolio. Nasdaq up 8%, closely followed by global equities up 7%, UK government bonds up 3%, and emerging markets up 2%. In other words, an extraordinarily wide rally. And in some more specialist investments, Bitcoin up a staggering 56%. That's after deep falls earlier in the year, of course. High yield bonds up 4%, and even UK house prices, as measured by the Nationwide, up 1%. So an incredibly inclusive rally. Let's look under the bonnet at what some of the movers were, and I show on the left-hand panel a chart we're very familiar with. That's the rally in the S&P 500 this year to date, and that dark blue block, the contribution of the 10 largest names. That includes the so-called Magnificent 7 tech and AI stocks. In the left there you can see that yellow bar though beginning to contribute, the other 490 stocks beginning to have a positive impact as at last those markets begin to widen out. So I think we've got the beginnings of much more healthy breadth in US equities. On the right hand panel I've shown the VIX index, that's a measure of volatility, at 13.1%, well below the 5-year mean. This equity recovery was particularly well behaved, if you like. So what lay behind this? Well, first of all, some extraordinarily good inflation numbers at last. In the left-hand panel, you can see the UK inflation rate down to 4.6%, better than expected. That dark red line, the euro area down to 2.4%, a really impressive print, 3.2% for the US. On the right-hand panel, I've shown that across a wider range of countries, and I've shown what else the inflation momentum, which is the monthly change of the year-on-year rate. In other words, are we drifting upwards in momentum or downwards? Dark blue is downwards, pink is upwards. And you can see that string of dark blue across a whole lot of names beginning to appear over the last 6 months. So falling inflation really a global phenomenon. In the next slide, another contributor, I think, was the impressive numbers from the Global Supply Chain Pressure Index. This is a measure of a whole lot of indicators that show how tight supply chains were. You saw it soar in the COVID years in that chart there, as global supply chains almost broke down across the world. It's fallen now right through the lows of the pre-COVID era, and we're really seeing a freedom probably in cheap Chinese goods travelling around the world that we haven't seen in a long time, and this contributes positively again to those lower inflation numbers. So what does all this mean for interest rates on the right-hand side? Well, I've shown in the thick line the central bank policy rates, and the dotted line their likely trajectories as implied by the international futures markets. That dark blue line, the US Federal Reserve, rates currently at 5.25% to 5.5%. We see in the market sees about 4 rate cuts in 2024 at the June, September, November and December meetings. Now, of course, the Federal Reserve don't like you to talk about rate cuts. They want to focus still on a squeeze because they want core inflation lower. But that is the direction the market is taking. Slightly less optimistic view, but still rate cuts next year from the Bank of England, and a sharp correction in the Eurozone where possible deflation will one day be a risk again. So you can see a really transformed interest rate picture allowed by those better inflation numbers. The next reason why I think the rally was so wide was because the shock from oil prices from the tragedy of the Israeli-Hamas conflict has not really come to pass as one might have expected. In fact, oil prices have gone down, not up. In that right-hand panel, I've plotted Brent crude at the red dotted line, the outbreak of war on October 7th, and see it actually come off by $8 or $9. Extraordinary. Why is that? Look at the left-hand panel and you can see the real price of oil back over 50 years. And the key factor to notice is that great or sharp rise in the oil price are accompanied by a much wider war with supplies of oil restricted on a much wider basis. The Arab oil embargo of 72-3, the Iranian Revolution, the Kuwaiti invasion and the Iraq war. Today, yes, we've seen some modest cuts by OPEC, but those are broadly defensive and broadly voluntary. So if there is one benefit to come out of this tragedy, it is that oil prices themselves haven't risen sharply and haven't derailed the global recovery. Finally, I think the other big factor that markets woke up to was the relatively benign and indeed attractive earnings prospects that we have for 2024. If you look at the FactSet numbers for earnings 1 year ahead from North America, Europe and Asia, they're climbing at 11, 12, 13%. Very attractive numbers given that, of course, the technology earnings were so strong this year. On the top right-hand panel, that means global dividend growth of around about 7 to 8%. That's particularly interesting if you measure it against an inflation rate that's falling now in the 2.5 to 3% level. Also healthy share buybacks. So quite a good fundamental backdrop for the market, particularly for earnings outside of technology. So what does all this mean in summary? Well, I'm afraid for the last 2 years we've been operating on TINA, there is no alternative. Equities, and particularly US technology equities, dominating all other returns as interest rates make bond, cash and many alternatives and other investments unattractive. That's now beginning to reverse as rates normalise, and my friend Henry Boucher calls it MADI, multi-asset diversified investment. In other words, we can go back to looking at returns from a range of assets that provide effective diversification. Now this is very important because of course balance funds have been under a lot of pressure the last 2.5 years. They haven't been able to keep up with anything like the US technology momentum, but that might now be changing and a renaissance in the balance manager might be back. Well, I hope so myself, and thank you very much.